Are you a commercial property owner? Do you hate paying the federal government income taxes? If so, cost segregation may be for you, no matter the asset class you own: multifamily, self-storage, hospitality, restaurant, office. Anytime someone acquires a property, you automatically get put on a thing called straight line depreciation. The federal government regulates if you buy a commercial asset, you would be put on a 39-year schedule. If you acquire a residential property, you'd be put on a 27.5-year schedule. All they do there is they're going to take your purchase price minus land value and divide it by 39 or 27.5. The trouble there is there's a lot of parts, pieces, and components that make these assets what they are, not all of which will last 27.5 or 39 years. We may be able to help. What we do is we go to an asset, we take a building apart on paper. It's an engineered based approach. So as opposed to taking purchase price minus land, dividing it by 39 or 27.5, we're gonna go to the asset, take it apart on paper, piece by piece, and then say, hey, not all of these parts or pieces are gonna last 39 years or 27.5. So we segregate those assets out, put them on their correct depreciable schedules, which shrinks the life of their schedules, which means we're accelerating their depreciation. What this means for you: more cash flow in the form of tax deferrals, income tax deferrals. Cost segregation will allow you to keep more of that hard-earned money in your pocket. When we put assets on a 5, 7, or 15-year schedule, we're accelerating their depreciation. This also leverages the time value of money concept. Time value of money states money today is worth much more than money down the line. So to defer your income tax today, keep that money in your pocket, put towards principal, pay down debt, purchase more property, is much smarter than giving to the federal government, which we don't care who's in office, left, right, center, they will not spend it well. A simple way to think about cost segregation and estimate what's possible for you and your investors is to take your purchase price, multiply it from anywhere between 5 and 8%. We like to do things conservative, so put it in perspective. If you acquired $1 million property, anywhere from 5 to 8% would be your net benefit, meaning your reduction in income tax, meaning your increase in cash flow. So $1 million property, we can net you anywhere from $50,000 to $80,000 in an income tax referral. What can you do with that money? Whatever you want, it's your money. If you had a $3 million property, that would be anywhere from $150,000 to $240,000 in income tax deferral. Last I checked, that's a nice down payment on another property where you can cost sig again and keep the ball rolling. On a $5 million property, it can be anywhere from $250,000 to $400,000 in an income tax referral. These are big numbers, it's not a joke. Why overpay the government if you don't have to? Now, you may be wondering, how the heck is this possible? Very simply put, we are an engineering firm. And so what we do is we go to the client's property and we assess it. We're going to measure things, takes lots of photos. And what we're doing is literally taking the building apart on paper and segregating every part, piece, and component that won't last 39 years if a commercial asset are 27.5. By doing so, we find a lot of things that should not be capitalized or depreciated over the life of the building. Recently, I did one of many collision centers for a large client of mine, and in 5-year property, some examples of 5-year property are moldings, raised wood paneling, accent lighting, canopies, awnings, specialty electrical, and building signage. So you may be saying, well, my building has that, and if it does, you're likely depreciating it over 39 years. Some examples of 15-year property, we call it landscaping or hardscaping. So some examples of this collision center we're speaking of: site drainage, there was landscaping we did, some parking lot, exterior signage, guardrails, and exterior fencing. So when you take that all together and we put these things on 5 and 15-year schedules, they're no longer on a 39-year schedule. We're accelerating the depreciation of those items, shrinking the amount of time they depreciate over, which accelerates the depreciation, keeps more cash in your pocket where it belongs. Another great part about working with CostSegKev is I work with clients nationwide. I have some examples in some asset classes that recently I completed. One was a 30-location Dunkin' Donuts portfolio in Michigan. We were able to generate, with all the locations combined, $3.8 million in depreciation expense. That netted my client a $1.4 million tax deferral, meaning if he owed $1 million in income tax in tax year 2023, he would pay the IRS $0. So that's $1 million in his pocket where you could buy more franchises, maybe hire a manager to watch over all of these, free up some time for him, put towards that, pay towards principal, whatever he wants to do. I also completed a pretty large project off Vanderbilt Street in Brooklyn, New York. I was able to generate $844,000 in depreciation expense for my client, which deferred $285,000 in income tax for him. And I did a very cool project close to home for me. I'm in Chicago, Illinois. It was a swim school. Lots of machinery, heavy duty filter machines and pumps and things. We were able to get my client a $200,000 depreciation expense, which saved them about $60,000 in federal income tax. All right, I know I'm throwing a lot at you guys. Lots of numbers, lots of maybe new language, new ideas. The good news is you don't have to worry about that. That's why I'm here. My job is to educate, get you to understand the idea of what we're doing, run some numbers, there's no cost, get the numbers in front of you and your tax pro so you guys can make an informed decision. The nice thing about working with me, I do not push, there's no BS sales tactics. It's, hey, I could create a good loss for you, can you even use it? Bring it back to your tax team. See if it could fit in your overall tax plan. If you're wondering, how do I get my hands on one of these analysis? Very simple. Go to CostSegKev.com. You're gonna see a few data points. I assure you this is not like filling out a life insurance exam. 5 data points. What's the address of the property? When did you buy it? What did you pay for it? Super simple. Fill that out. It comes direct to me. Give me 48 hours. It will take the time to work up a full-blown 10-page engineering analysis. No cost, happy to do it. I'll summarize what our findings, and of course, we could go over it together as well. Share with your tax team. I'd love to be of service. It's what I live for, actually. So call me anytime. Happy to be of service. Talk soon.